Morning, everyone. Thanks for joining. Thanks for taking time out of your day to run through this. Obviously, want to touch on sort of making repayments and how that can have a massive impact on your clients' cost of borrowing. So, for those of you who don't know me, I'm Isaac Allen, BDM for Standard Life Home Finance. One of the BDMs here, been here for a couple of years. And I think there's some names that I do recognise on the meeting this morning. So, thanks for coming on. So today, what I wanted to essentially run through is sort of our Horizon Interest Reward Plan, and sort of the background on it, why it was created, what we saw sort of, after the mini budget, some of the profiles or customer profiles that are applicable for this product, an overview of the plan itself for those that you that aren't aware of it. I appreciate there's probably people on here today that have seen it and maybe even recommended it, and how a small payment can make a huge difference over the term of the product. So I'll be touching on that. And I suppose that's not unique just to interest reward. That is across any product now. The market shifted with these products and making payments with being in a higher interest rate environment. And then I'm going to touch on the demographics of our customers, predominantly sort of the ages and where they're aligning to product-wise anyway. And then just a little recap on our features for those that don't know, whether that is the Horizon Plan or the Interest Reward Plan. Then just allow for some Q&A. So sort of, if anyone's got any questions, I'll just allow some time after that. However, please use the chat. Please butt in at any point and ask any questions that you've got. And then I just want to close with some updates of about criteria and some other bits that's in the pipeline. So excellent.
For that client, because in Scotland we have two registers. We've got the land register and the seasons register.
Sorry, I don't know who's
the seasons register is the old register.
Sorry, James, you have to mute there if that was you. Yeah, so let's crack on. So as I said, Isaac Allen here at Standard Life Home Finance. Thanks for coming on this morning. It's a little bit about the product and why it was sort of created. So essentially, we know sort of post mini budget, we jumped into a higher interest rate environment and had a huge impact on the cost of borrowing. But what we kind of saw out of that was a change in customer behaviour. So more and more people were looking to service the interest, whether on an ad hoc basis. Small payments can make a huge difference, on a 15, 20-year term. But that prompted us to create our Horizon Interest Reward product. I suppose also with that, there was the new guidelines last year with the Equity Release Council that sort of coincided with the launch. So that fit in nicely with this product. And as you're all aware, there seems to be a new one of these products coming out weekly at the moment. So it's the way the market is trending. It's definitely a huge amount of clients who do have some means to make payments, some disposable income per month to keep the roll up from rolling up as fast. And how affordability should be discussed with every client is something that the council is very keen on, and the FCA have looked at our industry in depth last year, and is someone in the 50s who's not making any repayments and letting the plan roll up for 15, 20 years, is that a good customer outcome essentially? So from there, what we've done, as you're aware, to the people who are aware of the product, is we've created this product where they can service the interest and they receive a rate discount, whether that's partially servicing it or servicing the full interest and more. So just want to make you aware, though, that we don't affordability assess, so to speak. So we're not going to be asking for 3 months pay slips, 3 months bank statements. We would assume that you've done your affordability checks like the mortgage writers here that would do on a traditional mortgage. So we're happy if you submit the application that you've done your due diligence on said client. So just a couple of customer profiles that this will fit. So you've got your traditional active lease customers, like I said earlier, since 2022 or back end of, we did see a huge increase of customer servicing interest. But you've also got the customers who maybe don't fit with the traditional mortgage now or RIOs due to the stress testing on there or their age, things like that. And so we do get a lot of customers end of term mortgage who are looking to keep servicing the interest or even overpay, who fit within this new product. You've not just got the age of clients as well, but you've got our sort of criteria that fits in nicely where there's no credit scoring, generally sort of good on adverse as well, CCJs. So that sort of supports there. It could even be clients who don't have traditional income, drawing money through pensions, cash, receiving cash for work and so on. So there's a whole plethora of reasons, that it fit. You'll know sort of more from day to day advising than myself on potential customers for this type of product. And I suppose just want to add in, I'm sort of heavily talking about interest reward, but this isn't just unique to interest reward. This could be our normal Horizon plan or any other lenders. It's it's the way that the market's trending with customers making payments just to reduce that cost of borrowing, where the client can protect some of their estate and even potentially rebroke these in the future as well, which is something I'll touch on shortly. So the plan itself is Horizon Interest Reward. Apologies to the people who are aware of this. There has been some changes to this over the last year or so. So it's always good just to run through it, make sure everyone's aware. And I appreciate that every customer can make payments. So just wanted to quickly brief you on this. And this is something we're looking to develop, as time goes by. I suppose it's a competitive space now, which is good. It's more, there's more options for your clients and our customers. So it keeps us on our toes as well. So essentially, it's a lump sum product at the moment. So no drawdown facility. It's available on our fee-free plans. It's also available on our fee paid plans as well. So small typo here, and it's currently on Horizon 300 upwards. But that is maybe something we are looking at in the future because we do go as low as 200. So maybe that's something we can look at, and even a drawdown facility because I think 56% or I suppose that varies. It does have a drawdown attached when it comes to a lifetime mortgage. So the rate discounts range from 0.02 up to 0.45. And I appreciate the 0.02 is a small discount, that's fair enough. But what I'd sort of like to go into the next slide, sort of even servicing a small amount and getting that discount can make a huge difference in the long run. So maybe don't focus as much on the discount as more as the customer servicing the interest, whether it's through this plan or an ad hoc basis. You've got 4 options available for servicing the interest. You've got 25, 50, 75, and 100%. And you've got 3 terms, 5, 10, and 15 years. So what's good about this plan is if they service the interest for said term, say 5 years, they will retain that discount thereafter. So let's use an example of 15-year term, sorry, a 5-year term and a 15-year sort of lifetime mortgage. If they serviced it for the 5-year term, they would retain that discount for another 10 years. So they will retain it. So a client that may fit that would be, client who's, 63, retirement age 68, and they know after 68 they're not going to have state pension, no sort of private pension or anything like that. On the flip side, it could be a client who's already retired, final salary pension, coming off an interest-only mortgage or a normal mortgage, who may want to go for the 15-year term. And this isn't, you can recommend, so our age goes up to 85. You can recommend this to a client who is 84. Sorry, bear with me a moment. Someone can't see the slides. I hope others can see them as well. Let me stop sharing and I'll reshare it, and hopefully that'll sort it out, Jacqueline. Okay. Bear with me, everyone. Any joy, Jacqueline? No. Anyone else have any issues with the slides? Okay. Right. The problem is I can't close it because it'll actually close down the whole thing. So I just tried to reopen it to see if that worked, but sadly not the case. Everyone else seems to be okay. Let me just try it one more time and then we'll go from there. Any joy, Jacqueline? Sorry, but I'll send it after, Jacqueline. Apologies. So I'm not too sure what's going on there. Yeah, sorry about that. Right, where was I? So yeah, so also I think the standout feature from this product for the people who aren't aware of it, to me anyway, is the facility to be able to overpay. So you can make overpayments of up to 10% on top of servicing your interest. So if your interest is, they're paying 100% of the interest, they can still make a 10% overpayment on top. So in turn, this is, and they can use this like a capital interest mortgage with no affordability, as I kind of said earlier, providing you're happy with the client's income and disposable income to make these payments. If they want to overpay, they can sort of make a 10% overpayment each year, whether they want to do it as part of the standing order, that's fine, or if they want to make a 10% overpayment in lump sum, then that is also fine. Also, just to point out here, because this probably does differ compared to a normal mortgage, if they do overpay, the payments do not reduce. So if your payment from the outset is £500, and let's just use the loan amount of 100,000, and they made an overpayment in year one of £10,000, year two payment will still be £500, just to make you aware. But what will happen in the background is interest is recalculated. Any additional monies will just go, still obviously be paying the interest. Any additional monies will just go straight into the capital part of the loan. So essentially, once you start overpaying, this does turn into a capital interest mortgage for those clients. I think you can pay these off within just under 8 years. If the client has got the income. So yeah, it's a great feature that we've got, and it is something that fits in nicely. I've had a couple this week, coincidentally, where they did have income. I think one of them was still part of a family business, so still receiving, I think, dividends, and they couldn't get a traditional mortgage or something to that effect. And I've had ones where, cash, drawing money out of pensions, any type of funds that maybe wouldn't fit in with a normal lender, if you like, or a high street lender. So it's a great feature, that, and I think it's one that makes us stand out in that regard, that they can overpay, and reduce the balance down. I appreciate not everyone's going to want to or has the facility to service an interest at 6% and then overpay by 10. But there might be that client who just wants to chip away at it and get the amount down. And then in the future, we've only got 8 years CLs, 8 years early repayment charges on these plans. So there's always that facility in the future to maybe look at rebroking them also. Whereas, other plans maybe 15-year to early repayment charges and stuff. So that's something we are proud of. I know I appreciate a lot of the market is now sort of moved in that direction too, with the shorter early repayment charges. Yeah, so this is sort of the example I've alluded to. So how making a small payment can make a massive difference over the term. So you've got sort of three scenarios here. You've got a 20-year roll up, sort of line one or line two, 6% interest. The amount owed after the 20-year term, 331,000. The release amount here is 100,000 for those of you who can't see it. It's just at the bottom here. Scenario two, this is a 5-year option with a 25% interest payment with still 15 years roll up. So as you can see, the discount is small, as I alluded to earlier, but I think the message is still the same. A client who's got some of available income, £125 over a 5-year period, total cost of borrowing then will be 304, or amount owed will be 304,923. Gross saving 26,000, but the net saving with the payments will be 18,597. So even that 5-year term of making payments, they're still saving sort of 18,500 against the estate. So it is a massive difference. A small payment, even lower than that, still going to be making a decent saving to the estate in the long run. And I suppose in this scenario, if they went for the 5-year option after year 8, ERC free, maybe rates are better at that time. It gives them more opportunity to look at rebroking the plan and getting a better rate in the future. And I appreciate you can't say for certain, who knows what's going to happen in 8 years. But it's a potential option in the future, when someone is servicing partially part of the interest, or whether they're servicing all of it. Then onto the 15-year option, so 100% of the interest for a 15-year term, with 5 years of roll up on the end. So the amount owed here, so 125,541. So it's what, as you probably remember, it's £100,000 worth of borrowing. So 25,000 difference after the 5 years worth of roll up after year 15. But as you can imagine, huge saving here of 119,979, and that is still with roll up on there. After, as I've said, after 8 years, it can be rebroked if applicable, if rates are better, and so on. So it's giving you, it's better for the client to stay in the long run. It gives the clients more option moving forward. 6, 7, 8% interest rates. Will they have the facility to rebroke it on a higher LTV plan in 8 years? I'm not so sure. So I suppose just to make you aware, like even a small payment can make a massive difference in the long run. 25% of the interest, because I appreciate for the most part in a the residential space, whether it's an interest only mortgage, it's for the most part it's going to be 100% or nothing. But when you're dealing with clients, 55 plus, and so on, obviously the income can be stretched. So a small payment like this does go a long way. So a little bit into our demographic here on our clients that we see, whether it's on our interest reward plan or our sort of horizon plan. So as you can see, the orange tab is the interest rewards compared to our blue tab. of our Horizon normal lifetime mortgage roll-up sort of plans. As you can see, pulling a lot more clients in who are sort of 70 and below. So as you can imagine, that probably does fit with what you think, clients with income and so on. But I suppose it's good for you to be able to visualize the product and see how it sort of fits with clients. And this isn't unique because, as you can see, we still get people sort of later on in life who are taking up this plan. But as you can see, as you get to 70, it just moves the other way. But for the most part, anyone who's under 70 or around 70, it's a real option for these clients. It's not just a lifetime mortgage with roll up. I appreciate there's going to be people who fall into this category who are taking a lifetime mortgage but still servicing the interest. But for the ones who it's applicable for, you can see the demographics really on the younger end of the spectrum. So it's just good to sort of show that visually, to give you an idea of where we sit with these plans and the ages. Just with, as I've kind of alluded to earlier, there's been plenty of these plans in the last couple of months come out. It's great that there is more choice there for advisors, and it makes it a more competitive space. But I just wanted to sort of dial in on what we offer and maybe how it differs to other ones. Maybe this has changed now with recent ones in the last week or so, but the discount is in there for life. So if they choose a term, 5, 10, 15 years, and they make the payments for that term, they will retain that discount for the lifetime of the mortgage. We won't, so if it rolls up for 10 years after the 10-year term, they'll still keep that discount of 0.2 or 0.25, whatever it may be at the time. And then just to make you aware of it, if they stop making payments, we don't claw back any discount saved within that term, just for anyone who's not aware of the product. So just wanted to make you aware of that in case you were wondering. 8 years ERCs, I won't touch on that again because I've gone through it numerous times. The overpayments thing also, I think for the most part, I think they allow for servicing the interest. Maybe there's other ones out there that allow you to overpay as well now, but we do allow for the overpayments thing. So if you've got a client who's looking to pay off this within, the 8 years or as soon as possible, then bear us in mind when you've got any clients of that nature. And I appreciate that may be few and far between, but you just never know. Downsizing protection from day one. It's a feature that we're really proud of, as we are with the early repayment charge exemption or the compassionate clause. So the downsizing protection from day one allows your client the comfort of knowing that if they were to want to move with it from day one, if they can't port the mortgage because it doesn't fit our criteria, then they can redeem the mortgage ERC free. So first port of call is to port it. If it's not applicable with us due to it's an age restricted property, moving abroad, just the criteria maybe in general, like near commercial, whatever it could be, then they can redeem it ERC free. And the ERC exemption, so the compassionate clause, so upon death or long-term care of one of the applicants, it's unrestricted, that ERC exemption. So if you've got husband and wife passes away, it's not a 3-year window like it is with others. It gives the client the comfort, like I said earlier, of being able to don't need to make a decision, straight away whether they want to move or stay in the home, because as you know, them 3 years can come around quickly once the dust settles and so on. Probate and everything else that can come with it. So that does come around quick. So they've got the lifetime, they've got of the mortgage to redeem it. I think there's another feature on this which is great. If they've got a drawdown facility and the ERC exemption or the compassionate clause is triggered, the drawdown clock won't reset if they take a further drawdown. So, if there was a pot left and they still wanted to access it, they can still access it, and it doesn't mean the clock will then reset at 8 years. So I suppose that's just something to highlight. And then I know that may not come up when you're sort of advising on the product, but it's just a nice touch that if they did want to stay in the home and they wanted to access more funds, but they weren't sure because they may then restart the clock, then they've got the comfort of knowing that they won't have to pay an early repayment charge of 8% in year one. Just an overview of our plans at the moment. So you've got Horizon 200 to 570, and this is on our Horizon plan. Interest reward currently at 300 to 570. Like I said, we are looking to enhance this. So hopefully that will move soon. Property values up to 5.1, loan amounts up to 1.5, and our age range 55 to 84 and 364. Make us aware if you've got any properties or loan amounts above those figures. We can always consider cases on a case by case basis if it is a grey area of criteria. So yeah, bear that in mind if you want to ever reach out to me or one of your other representatives. On our website, we've got plenty of case studies that you can access to support the narrative I've been talking about today with making payments and how it can make a big difference. I didn't want to specifically go through one, but there is ones that spring to mind where the clients have had adverse, divorce, and they just wouldn't fit within the normal realms of a mortgage due to credit score and adverse. So have a look on there. There's definitely some useful bits and bobs that will support you. We've also got the repayment calculators as well, and that'll help you have a look at if the clients decide to make any payments, how that can make a massive difference on the cost of borrowing. I appreciate that's probably in a lot of the sourcing platforms too, so maybe you rely on that more so. But if you want to sort of use ours, then feel free to jump on. There's plenty of stuff on our website to support the message about making payments and affordability and how that's sort of the way the market is trended. For the most part, that's me kind of done on what I wanted to run through with you. I will open the floor to any questions. There's some other bits I just wanted to finish off with some updates from me, but I suppose in regards to making payments, the Horizon Interest Reward Plan, you know, have you got any queries on that or anything to say? No problem. If you think of anything after the meeting or a little bit shy, just send me an email, give me a call. No problem at all. So just from me, just to finish off, thanks for coming on this morning. I do appreciate it. We're really proud of this product. It's been a really successful year now. I appreciate some of you will have seen some of these slides before, but just wanted to recap, point out some differences with sort of the demographic and just show you sort of a small payment goes a long way, as I've said numerous times. We've had a rate decrease that's landed, so that come in last night. So that was 5 basis points. Coincidentally, I've just had an email, I think, saying the same thing. So yeah, 5 basis points. So if you've sourced anything recently, have a look. We may be a little bit more competitive. Also, on the horizon will be some increased LTVs. Can't say too much more than that, but hopefully that will support you with your clients, because I know that's an area which is there's not as many is not as competitive as it has been previously. Let's just say, so hopefully that will support you moving forward. Don't have a date, but expect hopefully can give you more in the next couple of weeks. And then you may or may not have seen we've had some changes to criteria for the better. So we did change our criteria back in October, I believe. One of the things we took out was we wouldn't allow for remortgages from day one. That is now back in. So that's I appreciate it's not every type of client that you're going to be looking at. We'll be looking to remortgage from day one, but we do get quite a lot of inquiries who are looking for that. There is some caveats to it, but for the most part, it's relatively straightforward. We allow clients, if they've got a CCJ of under 5,000, to pay it off with the funds, where previously we didn't. So yeah, that's another a good addition. It didn't really make sense, if I'm honest, why we wouldn't allow that, but that's not, neither here nor there. And then the big one is commercial. We're definitely more, we'll definitely be able to consider more properties with this. We've got three grades. Feel free to reach out because I'll just briefly touch on it. So you've got three grades: grade 1, 2, and 3. So to give you an idea on grade 1, 2, and 3, what they look like is, and this is whether it's adjacent, so next door, above, across the road, we can consider. Because it's new, it will still go to Phoenix, but the feeling is once we've sort of run this for a month or a couple of months, it'll just be sort of standard accept. So grade 1 would be like barber shops, hairdressers, small convenience stores, village halls, post office, low-rise office blocks, things like that. So that'd be grade 1, where it's sorry about that, just got sidetracked. That will be accept. At the moment, like I say, we'll go to Phoenix for sign off, but that's something hopefully we can, moving forward, will just be standard accept. Grade 2, large office blocks, industrial units, car dealerships, petrol stations, supermarkets, high street, things like that. That is something that's going to have to go to a decision refer, straight off the bat, whether it's adjacent or close. Some of these may sort of be acceptable to Phoenix, some may not, but that's something we can look at more so. And grade 3 would be imposing industrial units, sewage treatment plants, recycling plants, incinerators, and nightclubs and things like that. I appreciate some of this may cross over with grade 2 and 3. Ultimately, it's going to be case by case, but the feeling is that we will accept more now on commercial. So please feel free to reach out. We can have a look at it. Sometimes I did one of these webinars, I don't know, a couple of weeks ago with one of the underwriters, and we were talking about some of the changes that are coming in. I suppose what you need to be aware of sometimes is like the layering that maybe some of the funders don't like, where just because there's a commercial close, there could be other things like pylons or A roads and things like that, or multiple commercial units close, that it just makes it more so that it's not I don't want to say a great proposition, but it may be saleability concerns and so on. But yeah, for the most part, we'll be more lenient on commercial. Please reach out if you've got any queries on that, and I can run through an example if you want me to. So yeah, bear with me. I think there's a question. Can't say definitively, but it's something we are looking at and have been from inception. I hope to be able to come on in the next month or so and give you that news. It's something that I believe that will enhance this proposition. So the question was, apologies, is will you be bringing the drawdown facility into Horizon Interest Reward? All I'm going to say is I hope so. I think that's what it needs, and yeah, the conversations are ongoing. So yeah, watch this space. Thanks for the question, Diane. I suppose that's it from me. If you've got any other queries, feel free to reach out. Thanks for your time this morning. I hope you've taken something from that. Like I said, small payments can go a long way. And yeah, have a great weekend and hopefully speak soon. Thank you. Oh.